Welcome back to CAPM. As I have mentioned before, it is the most well-known financial model, also very helpful in various different aspects. Today, we are going to quickly figure out how to, in fact, implement the theory of the CAPM that we have discussed earlier. Now, the question is, what do we do with actual data to the actual real world? So I'm going to now open this file called it's Excel file number 9, CAPM and MM. I'm not sure why this is not showing up. All right, here it is. So here we have in that particular file on to the right, we have all the raw data as we have seen before. These are all monthly data that we are looking at for this particular purpose. Now, just to make sure we are all on the same board, there is no reason that CAPM can only be estimated with monthly data, or that market model can only be done with daily data. You can do all kinds of various models with all kinds of various different data, as long as they are consistent with the different fields. And you just be and very careful. If you're using investment with maturity of 1 month, then you need to use the relevant T-bill with the relevant maturity, with the corresponding maturity as the relevant risk-free rate, and so on. Yep, just have to be careful you do all of this stuff, make it comparable and intellectually, inherently, internally consistent. However, having said all of that, it is almost essential to always do CAPM with monthly model, as well as with other with monthly data, as well as with other data, because historically so much of CAPMs have been actually estimated with monthly data. So a lot of the data, the betas, etc., that you will see available to you historically are with monthly data. So in order to have your numbers comparable, you will need to have to do them, apply your CAPM to monthly data in order to make them comparable. So let's first do for Apple, for the time period 2010 to middle of 2018. And this is, for instance, something that you should do as part of your weekly assignment, is to actually estimate your betas. So beta is, as we have discussed, the systematic risk, as well as the standard deviation of the residuals, which is the idiosyncratic risk as well. But those are essentially the two measures of risk that we get from the CAPM. Both of those you need to estimate for different time periods, for different securities. And here is the two things that we need to do before we proceed any further. Going back to, let's just put up the capital asset pricing model, the equation. All right, it is the return of the security minus the risk-free rate. All right, so what do we use as the risk-free rate? In this case, we are using monthly data, and the investment horizon, therefore, is that of, so we are going to use the US federal government debt, which matures in 1 month, as our relevant risk-free rate. Yep, as long as you're being consistent. And you also need the a return on a market portfolio. That so let's say here for our particular purpose today, we're going to use the S&P 500. Now, you could use the value weighted return on the entire market. You could use the equally weighted return on the market. You could use the Dow Jones Industrial Average. You can use, if you're using an international company, you could potentially also use a global index. you will have to make a judgment call. And as something that I have emphasized over and over again, anytime you're talking about a model and somebody asks you a question which goes like this: which of these 5 reasonable models should I use? The answer for a person who's dealing with today's big data world should always be all of the above, and see how different your results are depending on what different data field approximations you use, what different particular specification of the model you use, all of the above. All right, so we need to have a very good sense of how robust your models are, your estimates are, your predictions are, and so on and so forth. All right, so for, let's say, for Apple, for the time period 2010 to middle of 2018, we're going to use the S&P 500 as the proxy for the market portfolio. We are going to use the 1-month maturity US federal government debt, the 1-month maturity T-bill as our risk-free rate. All right, so let's make sure we get all the data right. This is the data for the monthly returns for Apple, which we have done a VLOOKUP taking from this year month field that we have created, just as we did earlier. There's no point in my redoing this for you. I cannot emphasize enough, you cannot just stack fields next to each other. If you do, that is wrong. You will absolutely get no credit for it in your weekly assignments, or in your midterm or final exams, or much more importantly, when you're out in the real world. You will not get credit for stacking fields against each other, because that would be wrong. As I have mentioned before, if you were using a more sophisticated data processing software such as Stata or R or SAS, then you would do a easier, I suppose you can say, way of doing the merge, which is, or more than easier, what is important is that it's less prone to error than in Excel. In Excel, because you have to keep track of which field you're having to merge in common with. That's something you have to do with any data processing software you use. But what in Excel you need to also keep track is which particular column. In this case, you can see you're looking up C3 from the data from the worksheet AAPL comma monthly returns. Yeah, but that's not too bad. The difficult part is looking at in this case the raw data April monthly return, because Excel does not actually recognize the field names. You have to give it the number in terms of first column, second column, third column, fourth column, and so on. So in this case, because we are for Apple's monthly returns, you need to get column number 2, 1, 2. For if you wanted to get the S&P 500 return, you would get column number 1, 2, 3, 4. You have to keep track of that. Now, interestingly enough, in a rectangular database like such as SAS, the orders of the columns don't really matter, because you actually have names for the particular fields. So, but in Excel, you actually have to keep track of the orders in which the fields show up. And anytime you're getting, let's say, a field from a teammate, you again have to go back and make sure you have the same number of columns, that the columns have not changed orders and so on. Okay, so these are the kinds of things that you have to keep track of in Excel that you would not have to do with with a more advanced data processing software such as SAS, Stata, or R. All right, but the point is we can still do it. We just have to be very careful, but we can still do it and do it right. That's our objective. So once again, please remember, we are going to, from the AAPL monthly return worksheet, the common field with which we are going to do the merger, which is that year-month. From that, the second column is where we have Apple's monthly returns, and column 1, 2, 3, 4 The fourth column is we have the S&P 500 data. So going back to where we looked at the AAPL S&P 500 data, this here gets you the monthly returns for Apple. This here is the monthly return for the S&P 500 index. You could easily do it for instance, if you want to do it with the value weighted return for the entire market as proxying for the market portfolio, then you would get the corresponding column from that particular data set. This is the monthly returns for 1 month maturity US debt, which we get from that particular worksheet in the same merger, which is the VLOOKUP for Excel that we have done. All right, then what do we need to do? We need to calculate the excess monthly return. So going back to our CAPM equation, it is the risk premium of the security in question, in this case Apple. We are going to regress the security of we're going to regress the excess return of the security in question, Apple equity, with respect to what on the right hand side of your equation. The variable is simply the excess return of the market in this case. So is S&P 500 minus the US maturity, US 1 month maturity debt. So this here is the first is column G, which is excess monthly return for Apple, which is monthly return for Apple minus monthly return for 1 month maturity US debt. So this is D3 minus F3. That gives you the excess monthly return for Apple. E3 minus F3 gives you the excess monthly return for the S&P 500 index. All right, so then we have to regress column G on column H. We have to be a bit careful because column 1 here is, and just with Excel, because Excel does not remember what names you have particularly given. You can make it remember, that almost makes it more complicated. So we will have to now regress this excess monthly return for Apple on the excess monthly return for the S&P 500. So in order to do so, we go to data analysis. When all this comes up, go over to regression. Okay. First is you would need to put in the input Y range. Before you do that, you can see there are these various boxes you can check. In particular, if you check the box labels, which I recommend you do, then you should, what this is saying is this column here, this cell G2 is included in the field that you are using as the range for the Y's. Yeah, and I strongly recommend, because this then shows up in the description of your econometric results. Without that, it can be very difficult to keep track of what's going on. So once again, I strongly recommend that you check labels. And so the input Y range, go up here and go G2 to G104. Then we need to input the X range. Again, starting with that H2 cell, which is the label for that particular data point, for that particular data field rather. And we select all of these labels to make sure you're telling Excel that there is that particular cell which is not actual numerical data, it's the name of that particular field. All right, so that's what we are going to do. We will need to get the residuals for our data, because remember, in order to get the idiosyncratic risk, we need data on the actual residuals. Should we have the constant 0 or not? Should this be checked? Now, the standard CAPM is where we don't have that alpha, or rather more accurately, the alpha is equal to 0 for our standard CAPM, right? There is no alpha. However, you can estimate the CAPM with an alpha, and the two issues. One is we find empirically that the alphas typically are very close to 0, and also in equilibrium, under those strong assumptions, the alphas are also equal to 0. So, you know, we'll find they typically make very little difference. So, but the standard is to have alpha equal to 0. So let's say we do that. We click check this particular box. Constant is 0. Let's make sure we are getting it right. Let's say we give a new name. Let's say we say Apple CAPM WO. All right. Okay. All right, so here we have our Excel, the results of the regression. This is why I was so strongly recommending that you actually put the label, check the labels, and actually include the labels when you're doing the regression data, because it tells you what variable the regression results are corresponding to. In this particular case, you only have one variable on the right hand side, so it doesn't make a huge difference. But later on, when we do all kinds of other variables, it's really very important to keep all of that straight. So please do follow the instructions on including the label for the particular variables that you are doing the regressions for. All right, so first thing that you need to do when you're doing any kind of a model estimation is to see if the model itself is significant. In order to do that, first thing we'll do is look at this is the F test for the model itself. So let's go to this particular significance, and let's put it in percentage terms. And we find that the significance is, the p-value is very, very low. It's 0 with 2 decimal points. So the model is significant. If the model itself is not significant, then we would be very suspicious as to whether the CAPM itself is meaningful. All right, that is independent of the question as to whether the parameters are themselves significant or not. All right, that's a different matter altogether. All right, let's make sure we are all on board with this. The excess monthly return for S&P 500, that's the variable. The coefficient of that is this 1.07. Let's say we put it in with just 2 decimals. So it's 1.07. That is the beta, the market beta. So the intercept, we have already set the intercept to 0. So that particular that particular row is meaningless. So we're just going to delete that particular row. The beta is 1.07, which is very close to 1. Just keep this in mind when we do it a little bit later. Now, in order to get the idiosyncratic risk, we're going to take the standard deviation. Now, what's the difference between the dot P and without the dot P? It's whether you're taking the population standard deviation or the sample standard deviation. For these large numbers of observation, they make absolutely no difference. So you take the standard deviation of all these residuals. This. We typically express this in the form of a percentage. So the idiosyncratic risk for Apple over this time period is 6.19%. The excess monthly return for the S&P 500. The coefficient of that is, therefore, that is the beta, the market beta is 1.07, which is very close to 1. To keep this in mind, whether this here, the p-value here is also very close to 0, which is saying that the beta in this case is significantly different from 0. That is a statistically significant result. That's therefore the CAPM estimated for Apple over this particular time period. Let's look at Tesla. So exactly the same way as we did before, we calculate the excess monthly returns for Tesla, we calculate the excess monthly returns for the S&P 500, and let's say we do our regression, which is the excess monthly returns for Tesla against the excess monthly returns for the S&P 500. So in order to do so, we go again to data analysis, regression. The input range is, we will start with this, with the label. We'll make sure to check that particular box. All right, so that here is the left-hand side variable, which is the excess return for Tesla. All right, labels we have checked. Input X range is I, starting from I2 to this. Labels, constant is 0. Let's say this one here is Tesla, CAPM without alpha. We asked for the residuals as before. All right. So what is the significance in this case? As we earlier, the p-value was about 0%. Now it is 4.74%. Still less than 5, just less than 5. So it is significant at 5%, not significant at 1%. But hey, 5% is a very good number. We'll take that. So what if this significance had been lower than that? What we would have worried much more is the fact that this is a situation where the market, where the CAPM is not being very powerful in terms of predicting the model. It's not doing a terribly good job. If the significance was the p-value of this particular test had been, let's say, higher than 10%, we would have been quite worried about whether to even use this. As we did earlier, the intercept is to be deleted because it doesn't matter. The beta here, the beta for Tesla is 1.08. Which is, what was it for Apple? 1.07. When we do it for Tesla, the excess monthly, the beta is 1.08, very similar. So that's the market beta. What is the idiosyncratic risk? Equals, so these are the residuals. So this is equal to standard dev dot p paren all these residuals. (7.61%). Do you see the difference? The idiosyncratic risk is 17.61%, whereas for Apple, it's only 6.19%. All right. So this is the interesting thing, right? With between Apple and Tesla, their systematic risks, the betas, are very similar, 1.07 and 1.08, very close to 1. However, the idiosyncratic risk, the firm specific risk, is only 6.19% for Apple, whereas it is 17.61% for Tesla. That is to say, there is significantly more firm specific risk when it comes to Tesla. Just to this idiosyncratic risk is and the market beta, I just keep these numbers in mind. Let's just see how the CAPM with an alpha would work out for Apple. So let's just go back to our data here and do exactly as we were doing it earlier. Go to data, data analysis, regression. Our input Y range, including the label, is the G's. The input X range is the H's. Labels, as we had earlier, because we have put these things in here. Input constant, now we will uncheck it. That is to say, we will let alpha be estimated through the least squares process. So click on OK. We forgot to name this, but that's easily fixed. AAPL, CAPM, W to indicate that with an alpha. All right. So in this case, the intercept, as we discussed, is actually pretty low. However, now these are the things to which give us reason to pause. This for Apple, the significance here, as we have discussed before, it's we need to always look at that. That number is 0.00%. Great. Let's look at these numbers. Okay. The intercept, the alpha is 0.01, which is tiny. However, before we get all carried away, let's look at what the p-values are. Let's put them in percentages. And the intercept, the alpha, is 0.01, which is from an economic perspective, pretty tiny, but statistically, the p-value is just over 5%. So it is actually not significant at 5% level of significance. So something to keep in mind. Let's look at the idiosyncratic risk. Let's put them in percentage terms. All right. So let's, the idiosyncratic risk is 6.18 in the model. This is the model with alpha. This here on the left is a model without the alpha. In the model without the alpha, the idiosyncratic risk is 6.19%. Over here, it's 6.18%. Tiny, practically no difference. However, without the alpha, the beta is 1.07. With the alpha, it's 0.98. You know, very close to 1, both of them. As I mentioned before, with an alpha, without an alpha, typically makes very little difference. And because also, as we saw, the alpha actual numbers also turn out to be pretty tiny. All right, so these are this is the kind of things you need to be able to do very, very carefully, depending on what it is that you're trying, what time period, what security, what sub-index, all of this stuff, being able to understand what the market beta is, the systematic risk, what the idiosyncratic risk, and so on, and also to be able to decompose the total variance between the systematic component and the idiosyncratic component, as I mentioned in the slide. Here you go, that the decomposition of the variance of the security in question between the systematic component and the idiosyncratic component. Some of the stuff as these things, these are actually come from my own research that's available on Blackboard. It's I think it's very important. I think it's very interesting. It matters a lot, especially when it comes to market efficiency. But let me quickly just point out to you as in the following sense, that if you go back to our let's look at this particular set of data, then the beta, which is the systematic risk component, according to CAPM's prediction, an investor should be compensated only for that systematic risk that the investor is taking on. All right, should not be compensated for the idiosyncratic risk. So therefore, Tesla and Apple, they have similar betas, but Tesla has about 2.5 times the idiosyncratic risk. According to CAPM, Tesla investors should not be compensated for bearing this extra idiosyncratic risk. Okay, so then is idiosyncratic risk is irrelevant? Is that true? No, it's not, because turns out whether the market for a particular security is efficient or not, one of the best measures of such efficiency turns out to be this idiosyncratic risk. That is to say, the higher the idiosyncratic risk for a particular security, the less likely it is that the market for that particular security will be perfectly efficient. Okay, that's something we will, a lot of my research and consulting are on market efficiency. We will talk about that at a later point in this course. And in terms of directly how we can, how this idiosyncratic risk turns out to be a driving factor behind market efficiency, there are some slides that I discuss. Please feel free to look at them. They are interesting, otherwise I wouldn't be studying them. Interesting to me, that is. But you will not be responsible for them in your exams or any other deliverables for this particular course. What are the special cases? In particular, if for a security that is risk-free, for instance, it's, let's say, a T-bill, then the beta for that particular security is exactly equal to 0. On the other hand, when it is the market index, then when you are you're calculating the beta for a market index, regressing that market index on itself, then the beta is exactly equal to 1. When it is on the examples that we just saw, where Tesla and Apple have similar systematic risk, but quite different idiosyncratic risk. It is often argued that beta greater than 1 signifies an asset of above average riskiness. Beta less than 1 signifies an asset of below average riskiness. Now, as I've mentioned before, is it always true that beta has to be positive? Not necessarily. Beta can be negative. If this is an example of a counter-cyclical asset, that can possible. Although if you look at the actual data, and I have, you would find very few situations where the beta is actually negative when you do with real data. But in principle, there's no reason why it couldn't. On average, betas will concentrate around the 1, and that's because the beta for the overall market is equal to 1. However, to keep in mind, our beta is to call it a measure of riskiness is, you have to just be very careful, because it is not riskiness per se, it is in how it co-moves with the market. So it's in the sense of its riskiness that you cannot you cannot diversify away from. That's a risk you have to incur, and that's the what the CAPM predicts is that the extra return, the excess return, the risk premium is a function purely of that systematic risk, not of idiosyncratic risk. All right. Why are we doing all this? What's the point of doing the beta? And so this here is something that we use over and over again, especially in corporate finance when you're trying to evaluate the riskiness of a project and so on. So you would directly apply this beta that you can estimate from the CAPM. So let's say the future price of the security. And the expectation of return is, of course, future price minus current price P naught divided by current price. And you simplify this, it turns to have this, just an algebraic simplification. Now you take this covariance of this particular expression, then this turns out to be equal to covariance of future price P with the market return divided by current price observed P naught. However, from the CAPM, we know that this beta is estimated by covariance of return with the market return divided by the variance of the market return. So that's great that we have this expression from the capital asset pricing model. We rewrite this and we then collect these terms, and we then see which is our objective as to what is therefore today's, what is the price. This turned the certainty equivalent price, because remember, we don't know what tomorrow's price will be. That's the uncertainty, is this expectation P divided by 1 plus RF, which is a risk-free asset, plus beta times expected rate of return of the market minus the risk-free rate. So this here, the term after the beta is the excess return of the market. So this beta times expected RM minus RF, that is the risk premium for that particular security. Okay, if for instance this did not have any risk, then this here beta would be equal to 0. So in that case, this risk premium, the risk adjustment that you're putting in would be exactly equal to 0. For a riskless asset, the discounting that you need to do is simply by you divide it by 1 plus RF, which is the 1 plus the risk-free rate. Excellent. However, if you, as is well, if it's not a risk-free, a completely riskless scenario, you would need to find a way to discount the payoff of the future. And in order to do so, you discount the expected value by the risk-adjusted interest rate. Okay, so in order to get that discount rate, that's plus beta times the excess return of the market. So let's say, for instance, it is beta is equal to 1. So the riskiness that you're evaluating is about average for the market. Then this here, 1 plus RF, beta equals 1, 1 plus RF plus expected RM minus RF. So the RFs cancel out. So it is then you're discounting by 1 plus expected return on the market, which is exactly what one would predict from the CAPM. If it has about average riskiness, about market level riskiness, then it should be discounted by the market rate of return. It's expected price divided by 1 plus market rate of return. So those are the kinds of extremes that we know and we can calibrate our models against. And this gives us this ability to use the proper discount rate that you would get from the CAPM. All right, let's pause now and we will regroup in a short while.